When people talk about the economy, they usually focus on stocks or inflation or housing, but the one thing that really controls all of it is interest rates. Interest rates decide how expensive your mortgage is, whether businesses hire or lay people off, whether stocks go up or crash. They even decide how strong your currency is. And it all comes down to one number, set by a small group of people in a room, and that one decision ripples through basically every financial choice on the planet. So let's start with what interest rates actually do. Interest rates are the cost of borrowing money. When rates are low, borrowing is cheap, and when rates are high, borrowing is expensive. That sounds simple, but the ripple effects touch everything, because almost every major financial decision involves borrowing. Think about buying a house, buying a car, starting a business, expanding your business, even going to college. All of that depends on borrowing money. So when the Federal Reserve lowers interest rates, they're making all of that cheaper. At the same time, when they raise rates, they're making it more expensive and more difficult to do those things. Think of interest rates as the gas pedal on the economy. Low rates accelerate the economy and high rates slam the brakes. And the Federal Reserve, they control that pedal. And their job is to keep inflation under control and the economy stable. So when things slow down too much, they cut or lower rates to boost spending. And when inflation starts running hot, they raise rates to cool everything off. But the thing is, whatever they decide to do, it doesn't just affect one area. It hits everything at the same time. Let's start with the most obvious place you probably feel this, your mortgage. Back during COVID, when the Fed had interest rates basically at zero, 30-year mortgage rates dropped to around 2.9%. So if you bought a $500K home back then, your monthly payment was around $2,100. Fast forward to today, and mortgage rates are closer to 6.25%, and that exact same house now costs about $3,000 a month. That's almost a 50% increase in your payment for literally the same house. Nothing changed about the home, nothing changed about your income, only interest rates changed. And that's why so many people who could afford a home at 3% can't afford one at 6%. So they stop buying and demand drops. And when demand drops, typically prices stop rising and sometimes they fall. And it's not just housing. Car loans get more expensive, credit cards get more expensive, and student loans get more expensive. Even a 0.5% increase on a $100,000 mortgage adds about $60 a month, which doesn't sound huge until you realize that's $720 a year that's now gone, and that's money you're not spending at restaurants, you're not shopping with, you're not putting it into your savings. So when rates go up, people naturally pull back. They delay big purchases, they cut spending, and they get more cautious. And when millions of people do that at the same time, it shows up everywhere. Retail sales slows down, restaurants get quieter, typically small businesses feel it first, and this is exactly what the Fed is trying to do when they raise rates. They're trying to cool demand and slow spending, because making money more expensive is how they fight inflation. And it's especially worse for people who are barely able to pay for their mortgages in the first place. That was a big part of the 2008 collapse. People who could barely afford a mortgage were given massive loans, and even minor rate hikes from the Fed destroyed their ability to pay those loans, and you saw tons of homes flood the market all at the same time. Now, let's talk about businesses, because this is really where interest rates start to hit the job market. When rates are low, companies borrow money to grow. They open new locations, buy equipment, hire more workers, invest in tech, because it's simple math. If you can borrow at 3% and your project makes 10%, you would do that all day. But when rates jump to 7%, that same project suddenly doesn't make sense anymore. The borrowing costs eat into the profits. So expansion gets delayed, hiring plans get scrapped, and equipment purchases get put on hold. And when thousands of businesses all make that decision at the same time, the economy slows down. This is usually where you start seeing it first, when companies that were barely surviving on cheap debt start laying people off. That's the ripple effect. Higher rates make unemployment start creeping up. And once people lose their jobs, spending drops even more. And it all kind of feeds on itself, and the Fed knows this. When they raise rates to fight inflation, they're basically accepting that growth is going to slow down and unemployment will rise. That's the trade-off. They're trying to pull off what's called a soft landing, slowing things down enough to cool inflation without causing a full recession. But it's incredibly hard to get this right because rate hikes, they don't hit instantly. It takes 12 to 18 months for the effects to fully show up. So a lot of times, by the time they realize they pushed too far or they didn't push far enough, the damage is already set in motion. Now let's talk about how this affects the stock market. When interest rates are low, stocks tend to go up because remember what we said earlier, companies can borrow cheaply to grow. And because when savings accounts pay almost nothing, investors look for better returns and they find them in stocks. But when interest rates rise, the opposite happens. Companies face higher borrowing costs, which hurt their profits, and investors can now get decent returns from safer investments like bonds or CDs. So they sell stocks and move money into those safer assets. This drains liquidity from the stock market and you see prices start to fall. The bond market works in reverse. When interest rates rise, existing bond prices fall. Because let's say you own a bond that pays 3%, then the Federal Reserve raises rates and new bonds are now paying 5%. Nobody wants your 3% bond anymore, so if you try to sell it, you have to lower the price to make it more attractive. This is why bond investors, they hate rising interest rates. Their portfolios lose value, so interest rates affect every part of the investment landscape. Savings accounts, stocks, bonds, real estate, everything moves based on what the Fed does. Now, if we look more broad, one of the most important things that interest rates control is the value of the actual currency itself, and that ripples through the entire global economy. When the US raises rates, the dollar gets stronger because higher interest rates attract more foreign money. If US bonds are paying 5% and European bonds are paying 2%, investors sell euros and they buy dollars, and they move their money into US assets. That extra demand pushes the strength of the dollar up. We saw this in 2022 when the Fed raised rates aggressively and the dollar jumped more than 11%. Now, a stronger dollar comes with its own trade-offs. On one hand, imports get cheaper. That same German car suddenly costs way less in dollars, which is great for American consumers. But on the other hand, US companies selling overseas get crushed because their products become more expensive for foreign buyers, making them less competitive. And for developing countries that borrowed money in US dollars, a stronger dollar is brutal. Their debt becomes harder to repay, their currencies weaken, and financial stress builds fast. So when the Fed raises rates, it's not just affecting mortgages and jobs in the US, it's shifting currencies, changing trade flows, and putting pressure on entire economies around the world, all from one policy decision. So even though interest rates affect so many things, the core reason the Fed raises or lowers rates comes back to inflation. Inflation happens when there's too much money chasing the same amount of goods, which causes prices to go up and your purchasing power to go down. The Fed targets about 2% inflation because that's what they believe is healthy and predictable. But when inflation starts running hot, like 5% or 7%, they don't really have a choice anymore, and their main weapon to combat that is by raising rates. By raising rates, they make borrowing more expensive, which slows spending. And that's what brings prices back down. The problem is, this does work, but it hurts a lot of people. Slowing inflation means slowing the economy, which usually means job losses and sometimes recessions. That's the tightrope they're always walking. Raise rates too little and inflation keeps ripping out of control, and raise them too much and you crash the economy. And to make it harder, they don't get instant feedback. It takes 12 to 18 months for rate hikes to fully move through the system. So they're basically making decisions today based on guesses about what the economy will look like a year from now. That's why they miss sometimes, and that's why aggressive rate hikes so often end with recessions. Interest rates aren't just a number that the Fed announces and economists debate. They control major financial outcomes in your life, and to make real informed financial decisions, you have to understand how they work.